Hello and welcome to the latest episode of Zach's Tech Talk Tuesday. My name is Ryan McQueeney, and today we're continuing our discussion on Q4 earnings season by taking a deep dive into the latest results from Google parent company Alphabet. We don't get a ton of major reports in time to talk about the actual results during the week of here, but we did get Alphabet on Monday afternoon, so I figured let's run through the latest from one of the pioneers of the internet and a key bellwether for so many of tech's many growth segments. Because I think a really interesting storyline developed in Alphabet's report yesterday afternoon. I'm not sure it's new per se, and I'm not saying I'm the only person noticing it, but I think it's important to key in on if you're interested in Alphabet and Google, and if you're interested in kind of the future of digital advertising and where these mega behemoths go next, and where companies like this look for growth and how that growth is delivered. So what did we learn about Alphabet last night? Let's start with the basics. Adjusted earnings came in at $12.77 per share for the fourth quarter, improving 31.6% year over year and crushing the Zacks consensus estimate of $11.08 per share. I'd note that Alphabet's bottom line did benefit from a $1.3 billion unrealized gain from a non-marketable debt security it held. Apparently, when you take that out, earnings were just $10.91 a share, which would actually be a miss of our Zacks consensus estimate. I think it will chalk it up as a beat in the Zacks system, but I'm not 100% sure what the best way to compare the figures are. Net revenue, which excludes traffic acquisition costs, which Google reports as the portion of revenue shared with its partners, was $31.8 billion. That's up to 23% year over year and ahead of the Zacks consensus estimate as well. But the stock was actually down in after-hours trading and opened lower today, although it did immediately stage a rally after the morning bell. Definitely give me a stock to watch all day. We'll see what our investors and traders want to do with this. What were the initial causes for concern, though? So something moves 3.5% in after-hours trading. There's something people didn't like. Well, it's a rise in expenses on a lot of different stuff, notably video content, cloud computing. That put pressure on operating margins. And you couple that with some kind of lingering concerns about regulatory scrutiny, and I think people were just worried about rising costs and rising expenses. And we'll get more to that later. But before we jump into the world of expenses and investing in your own business, let's touch on the positives and the growth catalysts. Revenues from Google-owned sites were up 12.3% on a sequential basis, and that of partner sites increased 14.6%, resulting in an increase of 12.7% in total advertising revenues. I'll take a second to say we're going to talk a lot about the future beyond Google's advertising business, but the fact that we're getting this type of growth still is absolutely insane. Yes, this is going to have to plateau at some point, but this business is still a health. We're still looking at double-digit percentage growth in the advertising business year over year, sequentially in this case. The year-over-year comparisons are pretty ridiculous as well, and that just boggles my mind. It's really impressive stuff from Google, and it really shows. I think it shows how many people around the world are still getting connected to reliable internet. How much the base of connected devices around the world, be it computers, but also smartphones, tablets, that type of stuff. How much that's still growing, as much as it is we're talking about it plateauing in places like the United States or even China. There are a ton of places where that network and that kind of framework is still developing rapidly. That being said, I think that the key growth catalysts I want to talk about today are found in what Google reports as other revenues. Other revenues for Google increased 39.8% sequentially and almost 31% year over year, accounting for 16.5% of the quarter's revenues. Now, Google other revenues includes Play, hardware, and Google Cloud and its apps. This is distinct from the other bets category, which people love to get all mysterious about and wonder what they're working on in the secret projects over at Google. We know it's typically non-revenue generating things or things that are just starting to generate revenue, such as Google Fiber and Google self-driving car projects would be an example of something that isn't quite at revenue generating. Waymo is the unit there. And then they kind of graduate things from other bets into other revenues. So I believe recently Nest, the smart home thermostats, moved from other bets into other revenues. Other bets revenues were just $154 million in the quarter. That was up almost 18% year over year, but that's just 0.4% of total revenues. And I think the unit lost something like $1 billion in the quarter. So it's a place that it's non-revenue generating. It's a way to invest in the future of the business. But these are projects that are far out. What I like about other revenues is it shows you kind of the next level above that, where we're really starting to generate revenue, a significant amount, almost 17% of the business. And we're growing very, very rapidly because we're focusing on some really exciting things. Hardware, like I mentioned, that's Nest, but that's also the Google Home, the virtual assistants that everybody loves. It's making a really strong contention against Amazon's Alexa products. Google Cloud, which has obviously been massive for the company and will continue to be a major player in the cloud industry, going toe to toe with Amazon and Microsoft and all the other major cloud players in the world. And then the Google Play Store, which, just like we talk about with Apple having this really fast growing services segment, the Google Play is a very similar thing. There's music streaming, there's, different mobile applications. It's a way that you expand your network of revenue generating services because you have this ecosystem of products and you're interacting with Play, and there's things to buy and things to purchase there. So I think that's a really interesting, this other revenues is the really interesting segment to be looking at right now. But interestingly enough, this is also, despite the really strong revenue growth, this is also probably what caused people to kind of raise an eyebrow initially at Alphabet's earnings report. So let's dive a little bit more into this kind of rising expenses and the fact that people are worried about how much Alphabet is spending right now. So gross margin for the quarter was 54.4%. That was down 329 basis points sequentially, and also down significantly year over year. This is kind of a natural thing. At some point, this is going to happen with the advertising business too, because price declines remain negative in year over year comparisons because the advertising continues to shift more towards the lower margin mobile business. That being said, I think other things were mostly to blame. First of all, total traffic acquisition cost was up 15%. I mentioned that earlier as that percentage of revenue shared with Google members that we strip out of our revenue estimates. But that's something to consider. The big thing, though, as I've been hinting at, is the spending. Alphabet used $6.9 billion for capital expenditures in the period. That is up from just $3.8 billion in the year ago period. Similar growth rate for the entire year. CapEx in 2018 doubled overall. That's the fastest growth rate in terms of spending that Alphabet has posted in 4 years. How did this happen? Why is this happening? And what does it mean? Well, this capital expenditure was explained by management as investing aggressively in cloud and hardware. How do you do that? Well, you got to pay people to work for you, and that costs money, especially when they're really highly trained and incredibly intelligent engineers. So one thing that the Google or Alphabet CFO Ruth Porat was mentioning in the conference call and in the press release was that they're investing significantly in engineers, hiring new engineers, not just for the ad business, but really in particular the cloud business has seen a strong uptick in headcount. Overall, lots of hiring at Google. As I said, headcount increased from just over 80K this time a year ago to nearly 100K. They ended the quarter at about 99,000 people working for Google, which is just a staggering figure. As I said, nearly 100,000 people working for the company. It's almost twice the size of the domestic coal industry in 2017. So, a really, really powerful force in itself, Alphabet. But as I mentioned, that's a lot of that's going to the cloud, and a lot of the revenue growth is coming from the other revenues in which the cloud falls. And to me, that's what the story is. We're seeing an increased focus on life after search. Now, I'll admit, we mentioned double-digit percentage growth in the advertising business, still remarkable, but Google already getting ahead of this, looking at when that digital advertising business is going to plateau a little bit, and it's already going to have the next thing ready to grow the business, already growing the business right now. But when it comes to these types of growth initiatives, you got to spend money to make them happen. It's the same thing when we talk about an actually small growth company that isn't yet profitable, especially on the tech side, where we look at things and we go, okay, well, we're going to look at this company's revenue growth because we understand that it's going to take a few years of spending and expanding and investing before it becomes consistently profitable. Well, when we talk about a segment of a larger business, it kind of is the same way. You're going to have to spend more on a smaller segment to grow it so that one day it can be more efficient and more profitable and a more important part of your business. And when you have the cash that a company like Google has, that should be less of a concern for investors. And I think it's one of those things where, yeah, you look at just the on paper, whoa, we doubled capital expenditure year over year. Stock moves down a little bit, even though the other results are solid. I think it's one of those things where it is an initial reaction, almost a programmatic reaction to the report. And when you really stop and think about it, it makes a lot of sense. And it's probably better that this spending is happening now before we start asking questions about, well, where is the growth coming from? So I see this spending as detailing and investing in Google's life after the advertising business's growth kind of expires. That's going to come in the hardware, the cloud, the Play, lots of different stuff. And I'm personally impressed by Alphabet's earnings report and looking forward to what comes next from the company. So those are my thoughts on the report, and let me know if you disagree, if you felt that I missed something, or if you want me to cover a different story. Shoot me an email, podcast@zax.com. Make sure to check out all of our other exclusive audio content at zax.com/podcasts. And please subscribe and leave us a rating on Apple Podcasts if you enjoyed the show. We're also available on SoundCloud, Spotify, Stitcher, lots of different places. Check us out wherever you get your podcasts. As always, thank you for tuning in to the Zax Tech Talk Tuesday show. We'll see you next time.